Candlestick trading is a very powerful tool in technical analysis. It provides us with great sentiment and market condition insights, and even signals us about trend changes and price reversals. Candlesticks come from 17th century Japan, and it is believed that they were invented by a rice trader to track historical price movements in the rice market, and has become the basis of Japanese investment philosophy. Only in 1990s, the candlestick charting techniques were introduced to the Western world by a trader Steve Nissen. Since then, candlesticks have gained huge popularity and can be found on every charting platform nowadays. Here's a quick recap about candlestick anatomy. The big blocks are called real bodies. The vertical lines above these blocks are upper shadows, and the lines below are called lower shadows. For a bull candle, here's the open, low, high, and close. And for a bear candle, open, high, low, and close. Large real bodies indicate strong buying or selling. Small bodies show that there has been low buying or selling pressure. Shadows provide us with the info of how high or low the price has been in a particular session. Long shadows tell us that traders haven't approved a certain price level, and when the price approached, they pushed it back towards its opening price. Doji candlestick have the same opening and closing price, so its real body appears as a horizontal line. It represents indecision in the market. Let's take a look what's going on when a doji forms. As session started, price was driven up by buyers, but it could have also been sellers driving the price down. Then, sellers pushed the price back to its opening price and even lower just to meet the buyers jumping in the market again and driving up the price to its open once more. This process could have repeated itself over and over till the end of the session where the price closed the same as it opened. As you can see, there is no real conviction about which direction the price should go, and that makes this candlestick signal neutral. I wouldn't advise anyone to make a trade based only on appearance of doji. However, if we see a doji after a strong bullish move and we are at resistance level, it could indicate that bulls have become exhausted and bears are ready to take control. Or the opposite in a downtrend. After a strong selling pressure, a doji appearance at support could indicate the bulls are getting ready to go long. The most important thing to remember when trading candlestick signals is to look at the context. A doji in the middle of a trading range means absolutely nothing and you should never trade it. A doji at support or resistance, however, is a completely different story. Now let's get into the interesting part. A doji has appeared at resistance. Remember, doji is a neutral signal, so don't jump in the market straight away. Instead, let the market come to you. Wait for a close below the doji's low and only then open your short positions. When placing your stops, you have to answer one question. What is the price that tells me I was wrong? So in this case, a candle close above the doji's high would invalidate the reversal signal, so I would place my stop couple of pips above the doji's high. A dragonfly doji is formed when the session's open and closing prices are at or near the session high. It is a bullish reversal signal, so we will only look for it in a downtrend. Bears were in the charge at the start of the session. They pushed the price lower, but then bulls rejected this lower level and were able to drive the price up to its open, where it also closed. A gravestone doji is the exact opposite of dragonfly doji. It is a bearish reversal pattern, and we will only look for it in an uptrend. Bulls were in control. They pushed the price up, but this new high was rejected by bears who managed to push the price back down to its open price. The long leg doji is a candle that have the same open and closing price, but have very long shadows on both sides. This candle signal shows complete indecision between the bulls and bears, and is not advisable to trade on its own. I know I said it once already, but this is very important. Candlestick signals are valuable only when looked at in the context. A doji in the middle of a range is a no-go. A doji at support or resistance, however, is something to be looked at. Marubozu is the exact opposite candlestick to doji. As the doji represents indecision in the market, Marubozu shows total conviction about the price direction. Bullish Marubozu open price is also the session's low, and closing price is equal to the session's high. This candlestick had no shadows at all, showing that buyers were in control for the whole time of the session. Let's take a look at how bullish Marubozu forms. As soon as session started, bulls were in charge. They were driving the price up for the whole session, and it closed at its high. Bearish Marubozu open price is equal to the session's high, and closing price is also the session's low. The same as the bullish version of the candlestick, this also had no shadows, indicating that sellers had control over the price action the whole session. Just as soon as the session started, bears pushed the price lower. They drove the price down till the end of the session, where it closed at its low. The Marubozu candle signal have no real trading implications on its own. However, as it clearly shows the current market sentiment, it can be helpful in situations like breakouts or reversals. As the price has broken the resistance level, the bullish Marubozu shows that there were no selling pressure from the bears, giving a larger probability that the breakout has been successful. Or, a bearish Marubozu at resistance could indicate a complete change of the current market sentiment and could lead to further decline. A hammer is a bullish reversal signal. It has a small real body, very small or no upper shadow, and a long lower shadow. For it to be a proper hammer, the lower shadow needs to be at least twice the size of the real body. As this is a bull signal, we will only look for it in a downtrend. Let's take a look at how hammer forms. Bears were in charge at the start of the session and pushed the price lower. This new low was rejected by bulls who pushed the price back up, creating a long lower shadow. This is how a typical hammer looks. But even a stronger reversal signal is a hammer where bulls manage to push the price above the session's open and close at session's high. A hammer seen after a strong down move at support is a very strong reversal signal and shows us that bulls may be ready to take control. The hanging man looks exactly the same as hammer. The only difference is that we can find it in an uptrend. A lot of trading literature says that the hanging man is a bearish reversal signal, and although it may be true in some cases, I would like you to think a little about what this candlestick really shows you. Remember that the hanging man forms the same way as the hammer, so after the price has been trending up for a while, bears start to push the price lower, but bulls manage to push the price up closer to its open, creating a long lower shadow. Does this really seem like bears are ready to take control over the trend? I'm not saying I would go long straight away after seeing a hanging man, but I would definitely be careful with my short positions, as this could signal about trend continuation. Shooting star is a bearish reversal signal. It has a small real body, very small or no lower shadow, and a long upper shadow. For it to be a proper shooting star, the upper shadow needs to be at least twice the size of the real body. Let's take a look at how shooting star forms. The session started with strong bull pressure. They drove the price up, but the new high was rejected by bears who managed to push the price back down. The reversal signal gets even stronger when bears push the price lower than the open and close at the session's low. The same as for hammer, shooting star has its own double at the other side of the trend. It is called inverted hammer and it can be seen during the downtrend. The inverted hammer is often considered a bullish reversal signal. But once again, I would like you to stop and consider before opening long positions after inverted hammer has appeared. Remember that the long upper shadow means that the initial bullish move was rejected by bears. And when trading reversals, we really want to see a change in the market's psychology. And whatever candlestick signal you see, a long upper shadow is by no means bullish. Bullish piercing pattern is a 2-candlestick bullish reversal signal. The first candlestick is a long bearish candle. The other one is a long bullish candle that has closed above the midpoint of the first candle. Here's how the bullish piercing pattern forms. The first session is in total bear control. They push the price down and the session closes near its low. The next session is complete opposite. Bulls are in charge from sessions open till close. The higher bulls manage to close the session, the stronger the reversal signal gets. Take a note that both candlesticks need to be with long real bodies. This is not a bullish piercing pattern because there is no real change in market psychology. We really want to see a strong bear pressure followed by a strong bullish reply. As this is a bullish reversal signal, we will only look for it in a downtrend. This is a bullish piercing pattern as it comes after a strong down move. This, however, is not because it has formed during a move upwards. Dark cloud cover is a 2-candlestick bearish reversal pattern. The first is a long bull candle. The other one is a long bear candle that closes below the middle point of the first candle. Here is how a dark cloud cover forms. First session passes in total bull control as they manage to close the session at or near its high. The next session is the exact opposite as the bears take charge and push the price down and close it below the first candlestick's middle point. The signal gets even stronger if bears manage to push the price lower. The same as the bullish piercing pattern, both of the candlesticks need to have long real bodies, as we want to see a complete change in the current market sentiment. As this is a bearish reversal signal, we will only look for it in an uptrend. This is a dark cloud cover, as it has formed after a strong move upwards. This is not a dark cloud cover, because it has formed during a downtrend. Bullish engulfing pattern is a 2-candlestick bullish reversal signal. The first of the candlesticks is a bearish one. It doesn't need to have a large real body, but the signal is stronger if it has. The second is a long bullish candle that completely wraps around or engulfs the first candlestick's real body. Note that both candlesticks can have small shadows as well. The important thing you have to look at is the real body. This is a really strong reversal signal because not only the second candlestick shows a change in the market player's psychology, but it also has managed to close above the previous candlestick's open. The signal gets stronger if the second candle can wrap around more than one of the previous candles. As this is a bullish reversal signal, we will only look for it in a downtrend. On the other side of the trend, we can see the opposite signal, which is called the bearish engulfing pattern. The first candle in this signal is a bullish candlestick, and the other one is a long bearish one that completely wraps around the first candle. Remember that bullish engulfing signal is only valid in a downtrend, but the bearish engulfing pattern only in an uptrend. Tweezer Tops is a 2-candlestick bearish reversal pattern. It consists of 2 candlesticks that have approximately same highs. Technically, Tweezer Tops do not need to have long upper shadows, but the signal works a lot better if it has. Let's take a look at how Tweezer Tops form. Price is driven up by bulls, but after meeting resistance, bears push the price down towards its opening price. The next session is exactly the same. Bulls manage to drive the price up once more, but the test is unsuccessful as bears take control and push the price back down again and manage to close near or at the session's low. Take a note that candlesticks can be reversed, but the reversal signal will be stronger if the second candlestick is a bearish, like this one. Tweezer Tops is a bearish reversal signal, so we will only look for it in an uptrend. On the other side of the trend, we can find the opposite signal, which is called the Tweezer bottoms and is a bullish reversal signal. The best thing about Tweezer tops and bottoms is that the signal clearly shows a strong support or resistance. Remember that any support or resistance level gets stronger the more times it has been tested. And with this candle signal, you get 2 tests in a row, which makes the support or resistance level even stronger than before. The morning star is a 3 candlestick bullish reversal signal. The first candlestick is a long bearish one. The second candle is a small candle. Perfectly, it will be a doji, representing indecision in the market. And the third one is a long bullish candle that closes above the midpoint of the first candle. As this is a bullish reversal signal, we will only look for it in a downtrend. As you can see, the first candle in this pattern is a bearish continuation. The second candlestick shows that the bearish momentum is slowing down, and only the third candlestick is an actual reversal signal. The signal gets stronger if the third candlestick is a bullish engulfing candle, meaning it closes above the first candlestick's open price. On the other side of the trend, we can find the opposite signal, which is called the evening star. The first candlestick in this signal is a long bullish candle. The second candle is a small candle showing indecision, and the third is a long bearish candle that closes below the midpoint of the first candle. 3 white soldiers is a 3 candlestick bullish reversal signal. All 3 candlesticks have large wheel bodies and have very small or non-existent shadows. The first candlestick is usually a bullish piercing or bullish engulfing candle. The second candle should be bigger than the first, and the third candle should be at least the same size as the second candle. The 3 black crows is a bearish reversal pattern. The same as its bullish counterpart, it consists of 3 long candles with small or no upper shadows. The first candlestick is either a dark cloud cover or a bearish engulfing candlestick. The second candle should be bigger than the first, and the third is at least the same size as the second one. The problem with both of these candlestick signals is that by the time they have fully materialized, the price may have already made the biggest move, so you can't jump in the market straight away. One way to use these signals is to determine when to get out from your existing positions. For example, you have been short here, and after seeing the 3 white soldiers appearing, you close your position to protect your profit. Another way to use them for trading is to wait for the price to retrace and then enter the market with smaller risk. Example here. After 3 black crows have appeared, you wait for the price to rise again and short the market here. Remember, just like with all the other candlestick signals, these are valid only when seen at support or resistance. 3 inside up is a 3 candlestick bullish reversal pattern. The first candlestick is a long bearish candle. Second is a bullish candle that closes at least at the midpoint of the first candle. And the third is a bullish candle that closes above the opening price of the first candle, creating a new high. As this is a bullish reversal signal, we will only look for it in a downtrend. Here you can see, in a downtrend, long bearish candle appears, as bears are trying to take out the support level. The next session shows that bulls are trying to take control as they manage to push the price up to the midpoint of the first candle. Take note that this is not a reversal signal yet, as often after the second session's recovery, bears take control again and manage to create a new low. That's why we need to wait for the third session, which closes above the first day's open, signaling that bulls have taken the full control. On the other side of the trend, we can find the opposite signal, which is called the 3 inside down. The first session is a long bullish candle. The second session is a bearish candle that closes at least at the midpoint of the first candle. And the third candle is the actual reversal that closes below the first candle's open price, giving us confirmation about reversal. Rising 3 method is a 5 candlestick bullish continuation pattern. The first candlestick is a long bullish candle. The next three are small bearish candles that fall within the range of the first candle. And the fifth candlestick is a long bullish candle again that closes above the first candlestick's closing price. Take a note that the third candlestick can be bullish as well. The important thing is that it still trades within the range. The falling tree method is a 5 candlestick bearish continuation pattern. The first candlestick is a long bearish candle. The next three are small bullish candles within the first candlestick's range. And the fifth is a long bearish candle that manages to close below the first candlestick's close and creates a new low. As the rising tree is a bullish continuation pattern, we will only look for it in an uptrend. As you can see, after a move upwards, a long bullish candle appears. The next three candles are small bearish candles which happen due to the profit taking. And the next candle is a long bullish one that takes out the previous candle's high, signaling about the continuation of the trend. On the other side of the trend, we can find the falling tree method pattern. In a downtrend, a long bearish candle appears, followed by 3 small bullish candles, and a long bearish candle that closes below the first candlestick's close, signaling about the downtrend continuation.